Imagine doing everything right, paying every bill on time, never missing a due date, never maxing out your credit cards, not applying for any new loans, not opening another credit card. For months, you feel like you're finally getting your finances under control. Then one morning, you open your banking app, and your credit score is lower. Not by a couple of points, not the normal ups and downs everyone experiences. We're talking 20, 40, sometimes even 60 points, gone, almost overnight. Naturally, you panic. Did someone steal your identity? Did your bank make a mistake? Was there a payment you somehow forgot? So you check your credit report. Every account says paid on time. No collections, no late payments, no fraud alerts. Everything looks exactly the way it did last month. So why did your score drop?
What?
The answer surprises millions of Americans every year. Because paying your bills on time is only one piece of the puzzle. Your credit score is constantly changing based on dozens of different signals, some of which most people don't even know exist. And one small change can affect your score far more than you think. Today, I'll explain the biggest hidden reasons your credit score can fall, even when you've done nothing wrong. And, more importantly, I'll show you exactly how to find the problem before it costs you thousands of dollars in higher interest rates. Let me introduce you to Michael. Michael is 33 years old. He lives in Phoenix, Arizona. He works as an IT support specialist and earns around $67,000 a year. Nothing unusual.
He isn't a finance expert, but he considers himself responsible. He pays every credit card bill before the due date. His car payment has never been late. He avoids unnecessary debt. He even checks his credit score every few weeks using his bank's mobile app. For almost 2 years, his score stayed between 730 and 740. Not perfect, but good enough to qualify for favorable loan rates. Then something strange happened. One Sunday morning, Michael opened his banking app. His score was 684. He refreshed the page, still 684. He checked another credit monitoring app, same number. His stomach dropped. How could this happen? He hadn't missed a payment, he hadn't opened a new loan, he hadn't filed for bankruptcy. Nothing had changed. Or at least, that's what he thought. That evening, Michael downloaded his complete credit report. He expected to find something obvious, a missed payment, a fraudulent account, a collection notice, anything that could explain losing nearly 50 points. Instead, everything looked normal. Every payment, on time. Every account, still open. No collections, no identity theft, nothing. The report looked almost identical to the one he downloaded 3 months earlier. Yet somehow his score had fallen dramatically. Confused, Michael did what almost everyone does. He started searching online. Some websites blamed credit cards, others blamed banks, some blamed the credit bureaus, others insisted it was completely normal. The more he searched, the more confusing it became. Eventually,
he spoke with a mortgage advisor. And that's when he learned something most people never realize. Your payment history isn't the only thing affecting your credit score. In fact, it's entirely possible to pay every bill on time and still lose points. Because your score isn't just measuring whether you pay your debts, it's measuring how you manage credit overall. And sometimes, small changes you barely notice send signals that the scoring models interpret very differently than you expect. Michael hadn't become financially irresponsible. He had simply triggered one of several hidden factors that quietly influence credit scores every single month. And chances are, if your score has ever dropped without warning, the same thing may have happened to you. So what actually caused Michael's score to fall? It wasn't one giant mistake. It was several small things that happened at exactly the wrong time. And that's the first thing you need to understand. Your credit score isn't calculated by a human. It's calculated by a mathematical model. That model doesn't know you're responsible. It doesn't know you always pay your bills. It only sees patterns. And sometimes, those patterns tell a very different story. The biggest surprise for most people is something called credit utilization. Imagine you have a credit card with a $10,000 limit. Last month, you charged $800. No problem.
This month, you bought a new laptop for $4,500. You fully intended to pay it off, and you did. But before your payment was processed, your bank reported that higher balance to the credit bureaus. To the scoring model, it looked like you were suddenly using almost half of your available credit. Even though you paid the balance shortly afterward, the higher utilization had already been recorded, and your score reacted. This catches people completely off guard, because they assume if I pay my bill on time, everything is fine. Not always. Sometimes, when your balance is reported, matters just as much as whether you pay it. Most people think the due date is the important date. Often, the statement closing date matters even more. That's usually the day your credit card company reports your balance. If your balance is unusually high on that day, your utilization appears higher, even if you pay it off a few days later. Think of it like taking a photograph. The scoring model only sees the picture that was captured. Now, let's talk about something else. Over the previous 6 months, Michael had signed up for a store credit card, applied for a travel rewards card, and used Buy Now, Pay Later for a couple of online purchases. None of these decisions seemed like a big deal on their own, but together they created multiple new credit events. Each application may trigger a hard inquiry. Each new account lowers the average age of your credit history. That doesn't mean opening a new card is always bad. It simply means opening several cards in a short period can temporarily lower your score. Buy Now, Pay Later services have become much more common. They're convenient, they're easy to use, but they still represent borrowing. Depending on the provider, the lender, and the scoring model being used, that activity may become part of your overall credit profile. The important point isn't to avoid these services completely, it's to use them responsibly. Multiple active installment plans, combined with higher credit card balances, can paint a picture of increased borrowing, and that's exactly what scoring models evaluate. Another surprise, closing an old credit card isn't always helpful. If you've had a card for 10 years and you decide to close it because you no longer use it, you may reduce your total available credit. That can increase your utilization percentage. It may also affect the average age of your credit history over time. Sometimes, doing what feels financially responsible has unintended consequences. And here's something even fewer people know. There isn't just one credit score. Different lenders use different scoring models. That's why your banking app, your credit card company, and a mortgage lender may all show slightly different numbers. That doesn't necessarily mean one of them is wrong. They're simply using different formulas. By this point, Michael finally understood something. His score hadn't dropped because he'd become irresponsible. It dropped because several small changes combined to create a different risk profile. The good news? Most of these issues can be improved, and some of them much faster than people expect. The first step? Pull your full credit report, not just the score, the entire report. Look for unfamiliar accounts, incorrect balances, duplicate information, or reporting errors. The second step, check your credit utilization. Add together all of your credit card balances, then compare that number with your total available credit. If you're using more than about 30% of your available credit, your score may be affected. Lower utilization is generally better. The third step, avoid opening unnecessary credit accounts. If you're planning to apply for a mortgage, a car loan, or another major loan, try to avoid multiple applications within a short period. Give your credit history time to stabilize. The fourth step, review your Buy Now, Pay Later habits. Treat these services the same way you'd treat any other form of borrowing. Finish one installment plan before opening another, and always make every payment on time. Finally, don't panic over small changes. Credit scores naturally move up and down. A few points one way or the other isn't unusual. Focus on building strong financial habits instead of chasing the perfect number every single week. Michael decided to stop guessing and started checking the facts. He paid down one of his larger credit card balances before the next statement closed. He stopped opening new credit accounts. He finished paying off his remaining installment plan. Over the next few months, his credit profile became stronger, and gradually his score climbed back above 720. Not because he found a secret trick, not because he paid a credit repair company, but because he finally understood how the system actually works. Here's the truth. Your credit score isn't designed to punish you. It's designed to estimate risk. Sometimes that estimate changes for reasons that aren't immediately obvious. The better you understand how the system works, the easier it becomes to make decisions that protect your financial future. If your credit score has dropped recently, don't ignore it. Take a few minutes this week, review your credit report, check your balances, look for the hidden factors we discussed today. You might solve a problem that could save you thousands of dollars in future borrowing costs. If you know someone who's wondering why their credit score suddenly dropped, share this video with them. It could answer a question they've been asking for months. And if you want to understand the hidden financial systems that quietly affect your money, subscribe to Buck Logic. Every week, we uncover another money trap and show you how to stay one step ahead. I'll see you in the next video.